Hello and welcome to the ASB Investment Podcast, a podcast that keeps you up to date on the market and helps you make smart choices with your investments. Before we get started, we should inform you that the views based in this podcast are those of the participants only. As individual circumstances differ, you should seek appropriate professional advice. I'm Jonathan Beale, General Manager of Wealth at ASB. Today, our Wealth Senior Economist, Tennent-Brown and I will be discussing some of the recent events that have impacted the markets and when the right time might be to react or just sit tight. Chris, wonderful to have you here to talk a little bit about what's been going on in the markets recently, which has been, I know, concerning for investors. Maybe before we start, do you want to give a little bit of background on Chris Tennent-Brown and what you've done in your career and how you've ended up here at ASB?
Well, I've been at ASB for quite a while now and have been an economist for both Commonwealth Bank in Australia and for ASB here in New Zealand. And the punchline for most of the career is, hey, there's all these things going on in the world. What does it mean for interest rates or the exchange rate or my house that I'm looking at buying? And right now, my focus over the past few years has been on what do all these events mean for my savings, which is great. But prior to that, I studied economics at Auckland University. Feels like a long time ago, but it does give you a bit of grey-head credibility, I guess, when it comes to talking about things that are going on in the markets.
It's interesting with the markets, how they've been over the last few months. I hear a lot about 1987, and in 1987, I think I was my first year at university in London. And then when I moved to New Zealand back in 2002, but one thing that surprised me was people were still talking about 1987 share market crash in New Zealand, where it's sort of long forgotten in the UK. I hear a lot of people saying, is this the same as 1987, what we're seeing now? What would your view around that?
I've heard the same thing, and people, I'm sure, still use 1987 as a reason not to invest in New Zealand, but not in the rest of the world. That was a really major downturn and for the share market, but also the economy was going through some massive changes. If I look back at 1987, when I was just starting work, I think a lot of people had no idea what they were investing in. And it was actually very hard to work out what you're investing in for a number of companies which evaporated off the share market during that crash. It was pretty severe. Now, if you look at the New Zealand market, it's very easy to understand exactly what all the companies that are listed on the New Zealand share market do. And they're all operating companies. It's not a whole lot of finance companies, a whole lot of property development companies. They're operating companies that we all know and understand. The Trade Me, Air New Zealand, Fletcher Building. They're all companies that we can see what they do in everyday life. And that's such a big difference to 1987. But it has had an impact on investor sentiment. I think we had quite a few other big crashes and corrections along the way, but 87 does seem to be the one that sticks out in people's minds. And every October, especially on the decade, the media does their bit as well by saying it's 30 years since 87 or whatever the number happens to be.
If you look at investment returns over the last number of years, it's been positive for quite a while. And one thing I suppose that's been missing has been any sort of volatility, any sort of up and down to the market. And that's sort of come back now. Is that normal or has it been abnormal previously? What's been going on, Chris, do you think?
Well, the normal thing is that investors hate uncertainty and markets usually get negative when there's a lot of uncertainty. So in that sense, what's happening at the moment isn't that unusual. There's a lot of uncertainty around. What is unusual is that we actually got through 2017 with all that same sort of uncertainty, yet it was a phenomenal period for investments. In fact, the US share market had the longest winning streak, 15 months of uninterrupted gains, when a lot of these things that we're worried about now were playing out. If I look at the last 10 years, it's actually been in a pretty good period for share markets, and there has been some uncertainty along the way. So I think the return of volatility, or basically the return of share markets dipping every now and then, is actually normal. And the abnormal thing was that we just could take everything in our stride through 2017.
And just to give a bit of sort of perspective of what's happened in share markets and the fall, how does that actually? Is it as large as people are saying, or what's actually happened?
Well, one of the things which is tough at the moment is it depends on what day you look at the markets. We've had some spectacular dips in late 2018, but we've had some spectacular bounce backs as well. At one stage, for example, the US share market was down around 20%. But on Boxing Day, it bounced up 5% in a single session. And so now, in the US share market, it's about 10% off the record highs that we set back in October. And that 10% dip is something that investors should expect to be happening reasonably regularly. If I look back over my career, we're literally in the dozens if I count the number of times share markets have fallen that much. When you start to get really big corrections, which we're not having right now, but a really big correction like the 87, the global financial crisis, well, hopefully those sorts of things only come along every decade or two. But a 10% decline over a quarter or so is more normal than people would think. And particularly when we've had such a good run of uninterrupted gains through 2017, I think it can be a little bit more uncomfortable than what it usually is.
Is there a particular one thing that's been driving markets down, or is it a combination of things? What would you say to that?
Well, a lot of the things we seem to find out these days come in the form of a tweet, which is something new about this current period of volatility. A lot of it stemming from the States and Trump's policies, which are a little bit unorthodox, and his approach to diplomacy differs from what we've had to deal with in the past. So that's one area of uncertainty. It flows into other parts of the world when you've got things like the trade skirmish going on with China. But on the whole, the one thing that's really troubling investors, I think, at the moment is the prospect of rising interest rates, because all those things I've talked about have actually been around for a couple of years now. But this question mark about how much higher will US interest rates go now that the US economy is going reasonably well and the Fed's well on a path to tightening interest rates is something that investors have been troubling with. We saw it back in February as well. And I think that's a fair question. Interest rates have been low since the global financial crisis, incredibly low. And central banks are now around the world trying to bring interest rates back up to more normal levels, and markets are struggling with that a little bit. And
here in New Zealand, outlook for interest rates continue to be lower for longer is what we're hearing, which will have an impact on share market here in New Zealand, I would have thought.
Yeah, well, it's been a positive backdrop for investments here and abroad, which is why share markets worry when it looks like this good thing, low interest rates, might be taken away from companies. But here, we're just not seeing the sort of inflation pressures within the economy which would make us think that the Reserve Bank's going to need to raise interest rates aggressively. So our central bank cut our official cash rate to a record low back in 2016. All other interest rates in the economy have been very low for a few years now, and we think that could persist for another couple of years. So that's tough if you're trying to make money out of a term deposit. But good news if you're a company. Most companies have a little bit of debt to fund their operations, and the fact that debt has been quite cheap and is expected to stay historically cheap is good news for our economy. In the States, of course, the question is, interest rates are definitely rising. How much further will they rise, and how much impact will this have on companies and their abilities to grow their earnings?
And then at Christmas, I was lucky enough to be back in the UK, and the number one story was Brexit, followed by the number two story, which was Brexit, closely followed by what Theresa May was doing at Christmas. Is Brexit going to have an impact on share markets around the world, do you think, or is it isolated to more UK and Europe?
I think there's two bits to that question, and the same with the US-China stuff. In the first instance, Brexit's definitely having an impact on the UK economy and UK financial markets. I mean, the first thing that moved, and this is often the case, was the pound. The pound weakened considerably after the Brexit vote went through in the first place, and the share market's struggling as investors try and work out what's the landscape going to be for UK US-based companies that are heavily exposed to Europe. I mean, the financial sector is a great example that's got a massive exposure to Europe, and it's a completely different beast if it's an island in isolation compared to an integrated banking system that operates throughout Europe. So those things have already been taking their toll on investments and financial markets in the UK. And the way forward is, as more news comes in, if it's good, people might start to get a bit optimistic and price in some growth for those businesses that they're looking at the share prices of. If it's bad, they could go down further, and that's why it's been such an interesting time to be looking at the UK economy. Now, the second impact I mentioned is this whole idea of cooperation and Brexit, what the US is doing in terms of their attitude to deficits and global trade. To me, they create an interesting question about global cooperation, because a backdrop through all of our careers, in fact, if we go back to World War II, has really been that we want to cooperate more and more, be it by having more integrated financial markets, trade agreements, and so forth. And that's really getting questioned when an economy chooses to leave an economic union like Brexit, or a president gets voted in on protection policies like Trump did. I mean, throughout my entire career and my qualification, the standard teaching is that tariffs are bad, trade agreements are good, and Trump will argue the exact opposite and can get elected on that promise. So there's some fairly sound economic theories that are getting questioned by politicians and voters at the moment, and that's where Brexit and Trump, I think, symbolise a bit of a question mark over the way the world will go forwards. Is it going to be like the last 30 years, or is it going to be different?
And I think when markets become volatile and people start to see their value fall, it's obviously worrying and disconcerting. But then I hear again that sort of uncertainty of what's going on now. People start thinking about the future's going to be even worse. Have you got a view about sort of the outlook? And because I think you can get yourself very worked up that it's bad now and it's just going to get worse, rather than are there some clear fundamentals that things are positive and actually looking at the medium to long term might be a better solution? Absolutely.
I think particularly the way the media works now, we get a lot of information incredibly quickly. And in the case of tweeting, it's completely unfiltered. So people are bombarded with information, and it can sometimes feel like we're at an absolute pivotal moment for the future of the world. And every day is potentially a pivotal moment for the future of the world. The way I put it into perspective as a long-term investor, I think, well, if I'm going to be saving for my retirement, I'm in this game for another 15, 20 years. I cast my mind back to what's happened in the last 15 to 20 years. There's plenty of moments where the politics is really scary, the events seem unsolvable, and yet we work out a way forward. That's the way markets work. That's the way that people work. And I look at Trump. It's a really difficult time for investors when they're getting bombarded with all this new information about the way that Trump wants global relationships to work. But I cast my mind back to the 90s. We had the Gulf War I in the early 90s. Markets got incredibly upset about that. Then we had Gulf War II. We had the terror attacks. There are all sorts of moments where we really questioned an awful lot about the way that world worked and didn't always like the way that global politicians responded to events. And in that sense, I get back to thinking, well, why would I expect the next 20 years to be any different from the past 20 years? I'm going to have a lot of uncertainty in the rest of my investment life. To a certain extent, you've just got to live with it, because a lot of the stuff in the short term makes a massive difference because it makes markets move up and down several percent in a day. In the long term, it's just part of the fabric that the world operates in.
And I always sort of think in the media and commentary around, investments or KiwiSaver or managed funds or whatever it is, that we always talk about shares. And, most people who invested in types of investments, the smallest part of their portfolio is actually shares. We don't talk about the sort of the cash element or the fixed interest element. And so, and if I look at the media, it's always share market, bloodbath, all those types of things. So flip it around a little bit. Diversification and all that sort of way people manage money, that's a benefit today for doing it?
Oh, absolutely. I think if there's anything over the last year or two that you take out of all of this is the evidence of the benefits of diversification. Like I mentioned, a lot of these worries stemming from the States were actually there in 2017. So if you thought the day that Trump got elected, I don't like the way that he's going to take US politics, you would have missed out on a phenomenal period of share market gains in the first year that Trump was in charge. It was just a great period for investments. Now we're worried about it a lot. So do you want to get completely out of one market just because it looks a little bit rocky? Well, the last couple of years I think have demonstrated that you shouldn't. At the other end of the scale, one of the questions we received back in September when the US share market was at a record high and so was the New Zealand share market. Why do we have all these pesky bonds in our portfolio that are doing nothing except dragging on returns? The shares are going great. These bonds are producing nothing. Yet bonds in the fourth quarter were the best performing asset class and buffered some of the volatility that share markets were bringing. And so I think it's just like any other time that I've been working, the diversified approach is still the one to go for. And an extreme example, I had no idea what was going to happen on Boxing Day in the share markets, but I certainly wouldn't have put any money on the US share market bouncing up 5%, and yet it does that. So on a day-to-day basis, these things are very hard to predict, and that's why long-term strategies and diversification, I think, are really important for most investors.
And if you're giving some advice to investors so what should I do in this current environment, what are maybe the couple of things that you suggest?
I think my parents' and grandparents' advice to not read the newspaper when you're feeling a bit down is a really good strategy because there's a lot of news and a lot of it you can't do anything about and it doesn't make any difference anyway. And so if you ignore some of the noise, what do you focus on? Well, I think you just focus on your own long-term goals. We as investment managers expect this sort of volatility. We don't know what Trump's going to do next or what the Labour government's going to do next or who will win the next election. But we do know that markets deal with this sort of uncertainty over the long term, both share markets and bond markets. So if we're managing money with that sort of volatility in mind, the most important thing is that the timeframes that we're thinking about for these investment strategies to pay off match up with individuals' timeframes. So rather than thinking, should I be changing strategy because of something I've read in the news, I think times like this are a really good time to reflect on your own investment goals and time horizons. I mean, certainly if this sort of volatility and events really upsets people, like you can't sleep at night, well, maybe it is time to talk to someone and get some advice because no investment should make you lose too much sleep. But if you're in the right sort of investment, and particularly if you've got 10 years to go, 20 years to go until you need the money and the investment strategy pays off, well, not only is now a volatile time that's a bit unsettling, I can guarantee that there'll be plenty more between now and 2038 or whatever the number is that the investment strategy needs to pay off. So to a certain extent, we've got to learn how to live with them and make sure that what we're doing is right for you.
I think it does sound a bit of a cliche, doesn't it? But focus on the long term and think about your goal. But like I was talking to my son the other night about he's 14 and what he wants to do in his next year at school. And it was like, do I want to end the year with a merit achievement or an exceptional achievement? I said, well, you just need to choose, Harry, like which one. And then there's going to be some stuff that you've got to do differently to get it. But you need to have a goal. You need to have something to aim for. It's just like investing, isn't it? Like, why did I make a decision to invest my money into something different? What was it for? And I think focusing on that does help. As you say, if I'm worried and I can't sleep at night, get some advice. But actually, what was the reason I invested this money? What was I trying to achieve? Am I still doing that? It does sound like a cliche, but actually it does work. Yeah, and I think it was Warren Buffett who said these are the sort of times where transfer of wealth goes from the impatient to the patient. Yeah, and I think that's just an awesome way of thinking about it.
Yeah, absolutely, and that's why I like when I'm trying to imagine what the next 20 years might be like, and the uncertainty I might have to deal with. Think of what I've already dealt with in the past 20 years, and then it normalises it a little bit. And we don't always like what's going on, and none of us like when markets correct like this, but would be dreaming to think that we won't be delivering more 10% drops from time to time from a share market over the next 20 years. That'll happen plenty of times. We can't predict them. Otherwise, you and I would be living on our Cayman Island resort. But we do know that they've happened in the past, and the way that we manage money works, and they'll happen in the future. And we just have to make sure that our investors are prepared for the sort of volatility that might deliver, or they've got a diversification strategy where they minimise the exposure to the things that they don't like if volatility is a real problem.
I'm glad you raised that, because it's very similar to the way we think about managing money. So, we ask investors to have a goal and what are you trying to achieve and work towards that, but don't suddenly change your beliefs or what you're trying to achieve just because things have gone a little bit different to what you think. And that's when it's tested. And I think what we try and do is go, well, okay, we've set our asset allocation. Do we need to change anything? Yes or no? And if you don't change something, you've still made a decision not to do something because you still believe in it. And I think that those processes and the way you do that are really important. And if you don't understand, then seek advice, ask the question, because I think more knowledge you get, then the better for you.
Yeah, I agree. And one of the things that I really like about working at ASB is that long-term focus aligns with my experience that I've built up over the years working in markets. I mean, the worst job I had was being a foreign exchange forecaster, because every day you have to try and work out what the exchange rate's going to do and then get beaten up by what it actually does. And that was a very short-term focus. If you accept that the day-to-day movements are very hard to predict, then automatically you start to focus on, well, what can I predict over the longer term? And then it's a case of going, well, what do I do when the day-to-day stuff is unpleasant, like we saw in December? And that's when it comes to having strategies where you can ride it out so that you get the 5% day on Boxing Day where markets bounce up, rather than sitting on the sidelines thinking that you know what's going to happen next and then be frustrated because you missed out. And so that alignment of real long-term focus for investments sits well with me, because it mirrors the experience I've built up as a forecaster.
And a lot of investors with ASB, Chris, some will be investing for growth, but some will be investing for income. And so they'll be in sort of more income-orientated portfolios. So volatility is still there, but the income stream's still being paid out. Do you want to sort of talk a little bit about how that works and dividends, and why is that consistent?
Yeah, I think it's great to bring up investors with an income focus. Because firstly, it's when the share markets get excited and we see these big dips that a lot of interest gets paid to markets. But a lot of investors are relying on income. We've talked about why markets will always have these periods of volatility, and that's just normal for growth-focused investors. They need to get used to it. Income-focused investors have got quite a different environment now compared to what they would have enjoyed over the last 10, 20 years. And that's because interest rates have really been falling since the 80s. They go up and down each year. But we were paying double digits on fixed interest investments in the 80s. You could get 12 to 15% on a bond. Some of our investors tell us about the 22% they paid on their first mortgage. Now, if you look at the bond market now, yields or the types of returns you'll get on a bond is down to 2 or 3%. Same with the term deposit. They're in that 2 to 3% range. It was only 10 years ago that you could get more than 6% on a term deposit. So the life for an investor chasing income is really difficult, because it is different from their previous experiences. Where New Zealand's a little bit lucky is the share market itself actually pays a good dividend yield. Now, there's a number of stocks in the New Zealand market that are still paying out very strong dividends, despite the fact that we've had a bit of volatility in the share market itself. So we can construct portfolios with exposure to bonds, a bit of exposure to shares for that dividend stream that can still generate quite a good income. And it's nowhere near the 6 to 8% people look back on and remember from term deposits 10, 15 years ago. But I don't think those days are coming back either. And particularly in the 80s, inflation gobbled up an awful lot of that return anyway. But this low interest rate environment, which is impacting income-focused investors, I actually think is going to be around for a little while. So how we construct a portfolio with the exposure to bonds, the exposure to cash, and any exposure to shares if that's appropriate, that's really important to try and generate the income that people want, because we can't get it from a lazy old term deposit like we're used to.
I was really surprised when I first moved to New Zealand that the people were lovely, the beaches were lovely, and shares paid really high dividends. And it's just a bit of an anomaly, isn't it? Like if you go to the UK or the US, there aren't this dividend payment that comes out of equities, but here there does. So it's a really good opportunity for people who are needing that ongoing income for a long time to actually be investing into New Zealand equities or Australasian equities.
Yeah, and the two headwinds over the past 20 or 30 years has been, one, what you mentioned. People will say, "Oh, there's no way I'm investing in shares after what happened in '87," which is unfortunate because, as we've discussed, the market's so different. And the other thing, which was a feature, was that the term deposits paid such high returns 10 years ago. I remember at one point in my career, I thought I'd helped make what was a great New Zealand share fund for people to invest in. And it had an expected return of around 8%, which is sort of what we'd still expect to get from the New Zealand share market over the long run. But people would rightly say to me, "Oh, I don't know whether I really need to do that. I'm getting 6.5% from my term deposit. Do I really need to take that risk?" And it does seem like a lot of risk to get an extra 1.5% and be exposed to shares rather than a term deposit. So now New Zealand actually looks a little bit more like the rest of the world with our interest rates being so low. And I'm speaking of term deposits and bond returns. And we're very similar to the rest of the world. But our share market still has that characteristic of a dividend focus, which is a bit of a plus for local investors.
And then looking forward a bit, anything sort of local events like elections and the tax review coming up, how do you see that impacting on markets?
Yeah, I think the tax is really interesting, and it'll get a lot of focus and the usual backwards and forwards from politicians. But for me, I think it's a wee way off. There's going to be some good ideas discussed, but ultimately it's going to be an issue for the next election. And as we've seen in the past, what a working group can come up with as some reasonable economic ideas is one thing, but working at whether it'll win you the next election is another. And so that'll be the game for the politicians, I think, as some of these tax things come out. But there's also some changes, and if we focus on property, for example, that's one area where clearly there's an interest. Capital gains tax on aspects of property is something people will be really interested in. And there already are tax changes impacting property, and the things like the restrictions on foreign buyers that are impacting property. So there's a lot of uncertainty over that asset class anyway. And then the tax working group findings will add to that. And then it seems like a new Labour government, but before too long we'll be in the run into the 2020 election when we're trying to decide, well, is this something that the country will vote for or not? A lot of
the media has obviously been around sort of international equities and the volatility and some of the falls we've seen. How has sort of local markets here in New Zealand and Australia compared to sort of international markets?
Well, we've gone really well relative to offshore markets. New Zealand market couldn't escape the downdraft in the fourth quarter, but it was in positive territory for the year. I think the overall share market was up nearly 5% for the full year, so much better than these offshore markets. And we're within 2 or 3% of the peak that we saw late last year in September. because we've had a little bit of a recovery through January as well. So our market's gone a lot better. And some of that's been one-off stories. Trade Me, for example, had a great return over December because their takeover issues there really drove the share price up. And at the other extreme, we've had some companies that have struggled as well. But in aggregate, the New Zealand market's been a much friendlier place to be over 2018 than offshore markets.
That probably plays into the earlier conversation we had around diversification and having some money in, not having money in all one asset class, having money in a number of different asset classes. So having some in international equities, some in Australasian is actually a good thing.
Yeah, that's right. I mean, the New Zealand share market has performed well, and our economy's gone incredibly well over the last 10 years. So it makes sense that it's been a good place to invest. But as we know, over the last 30 or 40 years, there's plenty of examples we can give where the New Zealand market's out of sync. Asian crisis, for example, our market really suffered and so did our economy. And it's times like that you'd be pretty happy to have some money in Europe or the US, as far away from us as you could have it from a diversification perspective. So I think the case is still there. For New Zealand investors, though, it's really nice that most of them will have a reasonable exposure to New Zealand assets, and they have performed better than the global assets over the last few years.
And it's interesting that you don't want to take all your money out of international equities and go, let's put it into New Zealand because that's doing better. But there is I know one of the decisions we made at investment committee was to sort of overweight a little to Australasian away from international. So you don't move the whole lot of money, but you sort of tilt a little bit more to Australasian, which is over the medium to long term should be an actual positive to the performance. Yeah,
and that makes sense. I mean, if we knew how to pick the winning asset class each quarter, it'd be a whole different ball game. But you and I are of similar age, and we've got a few decades of experience to say on a day by day and quarter by quarter basis, you can't pick the best one, but hopefully you get it the mix right over the long term.
Now I know you've got the Trump T-shirt and you stay at Trump Plaza when you can and Trump Spa. So I know you're a big fan of the Don, but. How has the government lockdown, how has that impacted on sort of markets over recent times?
Oh, Trump has changed things around quite a bit. For a start, the sheer volume of information we get and the way we get it is quite different. To put some perspective on it, though, I started to really focus on writing up ASB's commentaries in a different way back in 2017. And every month I would essentially have some new Trump news to talk about. And the punchline would be, and by the way, share markets had a great month. And that was the story right up until January, even though some of the stuff sounded pretty worrying. And then through 2018 it changed. We started to really get worried about a few things, including rising US interest rates in February, and then really focused in on Trump policies later in the year, with the real volatility we saw around the time of the US election in particular. So we have had to get used to that to a certain extent. But my advice to myself, as much as anything, but also to investors, is to a certain extent you've got to look through all of that stuff and focus on the fundamentals. How are companies actually going? What do they think of it? How are central banks interpreting a lot of the stuff that's going on, and what does it mean for their interest rate policy settings? And that's what I try and do. But it gets a little bit hard sometimes when you're getting such fascinating news feeds coming in.
Brilliant. Hey, well, Chris, firstly, I'd like to say thank you very much. I've really enjoyed talking to you as always, and I suppose what I like about it is that you've got your sort of background in investments, but also your background in economics. Now you bring the two sort of worlds together and how you explain things in a real simple, easy way to understand. So hopefully the people listening to the podcast have got something out of this and have learned something, and really enjoyed talking to you. So thanks very much for coming along today.
Thank you.
Thanks for listening to this episode of the ASB Investment Podcast. If you have any suggestions for topics you'd like to hear, please contact us at podcast@asb.co.nz.